Time for a quick macro review with the help of our friend Alex from Macro Ops, the best macro analyst around. We're going to talk about where the market is right now and why we can expect a 5 to 10% correction. Now, if you felt an emotional response to the word correction, then definitely check out our FOMO trading guide. It'll help you control those emotions, because those aren't what you want to be having when you're trading. But okay, as you can see, the market is still in its strong bull trend that started back in October. And if you look at the current price action, bears are not in control yet. For things to turn around, we need to see price kind of stagnate here and go sideways before it turns lower. Things don't usually just turn around 90 degrees real fast in one day. It takes a little time. We might be seeing that now, but we gotta wait and see. And if the bears do win and take over, we should see at least a 5% correction, which would bring us back down to the 3,100 level. So if you look at some of the signs like sentiment, you can see here that the put to call ratio is extremely low. You can see it's fallen below this red line down here. And the last time that's happened, you've had the markets go through a big correction. Right now it's at its lowest level since August of 2015. And this put to call ratio is the number of puts versus the number of calls. So if this was higher, this would mean that more people were buying puts, thinking that the market was going to fall. But the fact that it's so low with more people buying calls, thinking the market is going to go higher, well, that means people are just too bullish right now. And remember, the way sentiment works is that it's a contraindicator. So if people are really bullish, it's a bad sign. And if they're really bearish, it's a good sign. So right now, this is telling us that they're just way too bullish. So as Alex says here, the S&P's forward PE is back to its cycle high of 19, reached during the parabolic run-up in January of 2018. And you can see the last time it was this high, we had some rough times in the market. Now equity valuations are a firm headwind for stocks, bearing any major source of earnings growth. And because earnings are expected to decline for a second straight quarter, the only way Alex sees the EPS rising is if the companies keep buying back shares. One positive though is that there's still a really low hurdle rate for these companies to cross. The consensus estimates for net income of the S&P 500 companies is a negative 2.5%. That's for the fourth quarter of 2019. And that's so low that it's likely that a lot of companies will be able to clear that. And that would be good for their stock prices because you want them beating expectations to keep going higher. And the percent of stocks in the S&P 500 who have triggered MACD sell signals in the prior 10 days have reached levels that have preceded prior market weakness. So you can see here this green histogram when it's above the red line, that usually means that the market turns lower because that's that MACD sell signal. You can see it just raised above that red line and once again. So based on this information, Alex has reduced his core equity position from 100% to 25% in the Macro Ops portfolio. But he says the overall long-term picture for the S&P is still bullish, even though there's a high probability we see a 5 to 10% pullback in the coming weeks. The sell-off should help reset some of the valuation headwinds we're facing, as well as further re-rate expectations lower. So we're expecting this to be a pullback within the larger bull trend. So really it's a good buying opportunity. I've loaded up some money into my account that is ready to deploy as the market goes lower. And normally when I have new money to put into account, I kind of break it up over a few weeks, just put a little bit in each week, and hopefully during a time when the market is correcting. That way when things rebound, I get some good returns on that chunk of money. I hate putting it in when the market is just running higher and higher, because you're really not getting the best price. And that's really the only discretionary part of my strategy of when to add in more funds. And that's pretty much it for the market review. It was a quick one. If you haven't already, make sure you sign up to get our FOMO guide. There's a link down below in the description and comments. It'll give you a lot of good tips for how to control your emotions, and it's free. So just go to this link, put in your name and email, and I'll send it over to you. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get email notifications when our new videos come out. We're back to our regular publishing schedule, so you should see a lot more videos soon. So subscribe, and I'll see you in the next one. Stay fallible out there. Bye.